Thank you for that. And I think we have some breaking news, Scarlett.
We do. Lululemon CEO Laurent Pontevin, I hope I'm pronouncing that correctly, don't really speak French very well. He abruptly resigned from the yoga wear maker because the company said his behavior didn't live up to its standards. So he's also resigned from the board of directors as well. Lululemon was not specific about this alleged misconduct, and the board has already begun a search for a new leader. So again, the CEO has abruptly resigned from Lululemon. His behavior reportedly did not live up to its standards. Lululemon shares off by greater than 3% in after-hours trading right now. They are on the search for a new leader. Pontevin has also resigned from the board of directors.
Chairman Glenn Murphy to take over interim duties, I believe, and the company has reaffirmed their forecast guidance provided on January the 8th. Any more headlines on that, and we will bring them to you. As you can see, that stock down some 2.2%, though it is retracing some of the instant losses that we saw as those headlines crossed. Now, the plunge in US stocks just after 3 p.m. went beyond a normal reaction to economic circumstances and had elements of a liquidity-driven sell-off like the one that landed on markets in May 2010. That's according to one analyst. Dennis Deboucher, head of portfolio strategy at Evercore ISI, joins us now by phone. Great to have you with us. Please explain your thoughts.
Sure. So, and thanks for having me on. So, what we're saying is, given the algo-driven nature of the market, which makes up 90% of electronic trade, and not to get too much into the weeds here, the bottom line is, relative to history, market-making depth is smaller than it's ever been. So, when you have a macro stress meet a market stress, and the macro stress here being the potential increased inflation, much higher than expected rate hikes, and much stronger economic growth than everybody's been talking about. So your volatility increases meaningful relative to history. As algos and quants adjust to that and optimize to higher volatility, it creates the potential for lots of orders going in one direction when we just don't have the market making depth to offset that. And so today had hints of a flash crash. I mean, and we close at the lows, and you see what's happening with futures after hours, but negative 5.4% on the index is a significant move.
Yeah, I'm glad you brought that up. Worth noting that futures have continued to slide in after-hours action. Obviously, we've been talking a lot about this issue since the flash crash years ago, and various structural issues related to algorithms and quant stuff and all that. Are there things that you think still ought to be done from a market structure perspective to make things more orderly, or is this just how markets are going to be, where from time to time we're going to get these incredibly fast breaks?
Yeah, I mean, what should be done would not be my area of expertise. So I just think until such time that something is, and I'm not even sure what that would be in this kind of dark pool world, so how do you really regulate that? I think this is a regime that we're going to live in. We had optimized to very low volatility forever. And as we unwind that, we should probably expect more and more volatility going forward, and potentially more of these flash crashes across markets. I don't think it's just an equity phenomenon. I think it applies to currencies, obviously volatility markets, treasuries, et cetera. There was a treasury yield flash crash just a few years ago, and there was a sterling flash crash post-Brexit. So, I mean, I think it's something that is endemic across asset classes.
How do you recalibrate for that, though? Because we could see this spike higher, and then it could all go quiet again, and we see this incremental increase in stock markets again. How do you recalibrate and make an assessment on how you need to react if we do see a higher volatility environment here of some sort going forward?
I mean, well, not to be glib, I think one thing you do is not sell volatility every single day, or short volatility, I should say.
Okay.
You know, I think...
Which is the position the markets were in, unfortunately.
Yes, it is. I mean, I think having an assumption that volatility shall stay low forever is probably something that is a way to avoid this. I mean, the other way is just hedging when volatility is low. So besides that, I think it's very difficult. The main question we all have to ask ourselves now is, has something permanently shifted? Is this more than just a flash crash? Is this a permanently higher volatility regime that leads to a normalization, if you will, of valuations across asset classes? And if that is the case, then we actually could have further to go on the downside. We do not think that's the case, by the way. I'm just saying that's something that we're going to have to be on the lookout for.
Yeah. You know, this conversation reminds me of what we discussed with Neil Sauce of Credit Suisse when we talked to him, and he said that surviving the last 5 to 10 years meant being short volatility. The question now is, how do you unwind the short volatility trade in an orderly way? It's been such a crowded trade, and we've seen little instances of volatility start to creep up. No one is necessarily, at the time that we spoke, doing that, but perhaps that conversation is coming to the fore and people are starting to unwind some of that trade.
Dennis?
Yeah, I completely agree. I mean, one of the things you bring up, there's direct short volatility trade, which is being short the VIX, and there's the implicit short volatility trade, which is being in long duration assets across the world, which is Chinese real estate, which is Chinese tech companies, which is U.S. long duration growth and momentum companies. And so the implicit short volatility trade is across asset classes, long duration bonds, et cetera. So that it's tough to imagine that's going to unwind in a very orderly fashion.
But to some extent, I mean, as you're saying, the implicit short volatility trade, we're all assuming any of us have savings or 401ks or anything like that. Most of us at some level are implicitly short volatility. So it's just this extra juice that you're talking about, where these people, in addition to their sort of normal portfolios, are betting on a specific decline in the VIX.
That's exactly right. One of the kind of potentially nasty outcomes of this is that to offset the short volatility trade, which is being, long duration assets and yields being very low, pension funds have shorted actual volatility to raise income. Okay?
Yeah.
So, I'm sorry, go ahead.
No, I was just going to say to you, is this a mindset shift here from, we were talking about this earlier, a return on capital to a return of capital? And if so, do you go for the traditional trades here, like gold, long yen, treasuries, which is kind of the price action that we've seen today?
Yeah, I'm not so sure that shift has officially been made. I mean, I don't want to make too much out of one day as dramatic as it was. We'll see over the coming weeks. At the end of the day, earnings are still very strong. At the end of the day, macroeconomy is still very strong. And although we think inflation is moving higher, it shouldn't be moving higher to a level that should create a higher recession risk or some type of shortening of the business cycle.
So the message is don't panic.
Yes, exactly. So I would say the message is don't panic. But that being said, cash, which is now actually yielding something, might be an option.
Aha, good point.
For so long, we've been waiting for any sign of volatility. And now that we've finally gotten it, it's caught people off guard. We're calling it a flash crash, for instance. Is this something that could be good news for banks for their trading divisions after the not so great numbers we saw out of their capital markets the last quarter?
Yeah, I mean, I think it's very positive potentially for bank stocks. Given across asset classes, you're probably going to see volumes increase. I think it's good for active management, by the way, which is an important point. I think this is very bad for passive management. It is, to the extent that this type of stuff continues, because people have taken passive management or ETFs to mean less risk, and that's just not the case. That it just assumes that everybody has an infinite time horizon to hold things, and some people need money tomorrow.
And this is such an important point, because we've never seen greater accumulation into passive funds versus the active here, Dennis. So to what extent is that driving the price action that we're seeing? Because if it is, and to what extent, then that's something that we're going to see consistently going forward too.
Yeah, I mean, it's tough to pin exactly how much of the short-term action, at least, is been ETF driven and passively driven. Anecdotally, it seems like a tremendous amount of it on the day. But yeah, I think that is something that I think on a go-forward basis, to the extent that people question the safety, if you will, of passive investing, then it could be a sustained shift out of passive funds.
Yeah.
Dennis, I'm amused by something you said a moment ago about how cash for the first time in ages is actually paying something. So at the beginning of the year, when people were dumping dollars like crazy, was actually the first time in a while which you could actually get paid for holding dollars. This whole sell-off aside, ignoring today and yesterday, is there starting to be a case for just structurally holding more in fixed income, given its higher yield?
Yeah, I mean, 2-year rates are above the S&P dividend yield. I mean, 10-year yields before today were almost 1% fully above U.S. dividend yields. So, yeah, I mean, there is a case. I mean, if you can get a 2-year bond with a dividend yield above that of the S&P, and of course you don't have future earnings risk with the 2-year, then yeah, there's absolutely a case if volatility is increasing.
Dennis, going forward, when clients call you and they ask you what should they be doing in the days to come as they wait for the dust to settle, how do you advise them?
Yeah, I mean, Unfortunately, I guess there's two ways to look at it. One, it doesn't seem like at a place where the Fed is going to ride to the rescue. So the last few times we've seen spikes in the VIX, it's also come with significant widening credit spreads. It also happened when the economy was much weaker and the zero lower bound or constraints on monetary policy were greater. So you'd have immediate Fed responses. I don't think we're going to see that, which means you just have to wait for exhaustion. And unfortunately, that's hard to do. But I think a lot of clients are going to be waiting to see if there's a risk parity whale to surface, if there's a CTA whale before they step in.
Wait, what do you mean by that?
There's worries out there in the market that risk parity funds are becoming under pressure. Other kind of short duration trades, if you will, short volatility trades that are expressed through, say, risk parity or CTA funds, et cetera. If there's, or quants, if there's some large unwind happening right now that's going to bring a whale to the surface. I don't know if that's the case. I don't think anybody knows because it's tough to get that information, but I'm sure as heck not going to advise to front run. I mean, you're probably better off waiting to see where the dust settles here before making any aggressive action. So I think we do probably settle in the next few days, and it's not a snapback, but a grind higher over time if no whales surface. So obviously we don't want to create greater alarm perhaps, but as you said, this is something that's been talked about more broadly in the markets. But just by definition, when we're looking at asset prices at the level they were and the run-up that we've seen in January and the tight credit spreads that we see globally in particular, doesn't that just make investors, make the markets actually more sensitive to a pullback or a rise in rates that we've seen just on a valuation basis? It kind of ties to the point that you were making about 2-year yields. Yes. Yeah, I mean, absolutely. I mean, so it's the one thing about valuation now, which is so difficult, is that we're so far outside the normal bound that it's tough to anchor to it right now.
Yeah.
You know, and so if we were to return to normalcy, which means return to normalcy in the VIX, 10-year yields, term premium, consumer confidence, whatever, that would imply a lot lower multiples than where we're at.
Yeah, and that's the key point. Yeah.
Yeah, so.
Dennis, great to chat to you. Thank you so much for your insights and for answering whatever it was that we threw at you. Fantastic. Dennis Duboucher, Head of Portfolio Strategy at Evercore ISI.
All right, let's stay with the sell-off here. We're bringing in our Julie Hyman. She's trying to log into her Bloomberg, so let's just recap some of the numbers here for you. The Dow Jones Industrial Average losing 1,175 points on the day. That is a 4.6% decline, and it is now down for the year, off by 1.5%. The S&P 500 losing 4.1%, a loss of 113 points, now off 0.9% for 2018. The NASDAQ, surprisingly, guys, is still higher on the year, up by 0.9%, despite losing 273 points or 3.8% on the day.
The NASDAQ had more cushion.
The NASDAQ wins again after trouncing everyone else in 2017, even with how crazy this year is. Still NASDAQ is winning.